Good morning or afternoon, depending where you are. We have a packed house today. We have people from well over 40 states attending, as well as a handful from overseas who have taken an interest in this very important topic. So I'd like to welcome you all to today's webinar, Why 280E No Longer Applies Ahead of Rescheduling. Thank you all so much for joining us. I want to first thank Calyx CPA for making this webinar possible. Calyx CPA, headquartered in Southern Oregon, is a boutique tax and accounting firm specializing in the unique needs, as we all know, of plant medicine companies. It provides solutions to effectively mitigate the impact of 280E and offers comprehensive business consulting, entity advisory, tax planning, and tax preparation to companies across the U.S. Before we dive in, excuse me, I have just a few housekeeping notes. For those of you who have joined us before, you know all of this, but I'm just going to go over them very quickly. We will be leaving time at the end of the webinar for Justin, our speaker, to answer questions, and I'll be introducing him in just a second. So you can submit your questions anytime during the webinar. If you would do so you should see a Q&A box at the bottom of your screen with a little question mark in it. If you would submit your questions there, it helps us to be able to see all of the questions in one place to make sure we can try to get to them. Our speaker has also graciously offered to answer any questions that he's not able to get to at the end of the webinar via a direct follow-up. So you will get an answer to your question at some point soon after the webinar. Also, we get a lot of questions about this. We are recording the webinar and we will be sending a link out so you can view the recorded webinar within a few days maximum after today's live event. With that, I am pleased to welcome our speaker, Justin Botillier, the CEO of Calyx CPA LLC. With over 20 years of experience, Justin has dedicated his career to supporting small business owners. Even before the legalization of adult use cannabis, he was an advocate for the industry within the accounting profession. In 2016, Justin sold his general accounting practice to focus on serving the cannabis industry. He now specializes in business advisory services and strategies to mitigate the tax impacts of Section 280E for cannabis-related businesses across the nation. So with that, I am now pleased to turn things over to Justin. Justin, welcome.
Yeah, thank you, Noelle. Thanks for the introduction. My name is Justin Botillier. I'm CEO of Calyx CPA based in Medford, Oregon. I have spoken on this topic probably well over a dozen times between webinars and conferences and whatnot. And it's a very long presentation. I think if I started from the beginning, it would probably take 2 hours at least of nonstop talking to kind of introduce, the history that I have had with this topic. I have been, like Noelle said, I have been working with cannabis businesses before or during the medical days in Oregon, where I got my introduction to 280E. And early on, I just had worked with outdoor growers because I live in Southern Oregon, and that's kind of like Northern California, Southern Oregon are very similar in terms of climate. And so we have a big outdoor sun-grown cannabis industry here. And early on, I got introduced to farms, and then when I started doing farm returns, I started to learn about this tax penalty 280E. Now, many of you, there is a lot of information on 280E online, and you will be able to find it very quickly in terms of what 280E is, what is deductible, what is non-deductible. There are some current strategies to mitigate 280E. It is a spectrum on how aggressive an accountant may use those strategies. I happen to be on the more aggressive side of tax codes such as 471C, which is currently being used by the cannabis accountants that actually are doing their homework. And so if you're working with an accountant that doesn't know any strategies or just disallowing your deductions based on the surface level understanding of 280E, then you definitely need to look around for that. One thing I like to tell my audiences and my clients and whatnot is that it's not actually the IRS that will bury you in tax debt, it's your accountant that will. Because the IRS definitely uses deterrence strategies of deterrence to try to get you to comply and make sure that you're filing the returns that are going to favor the IRS as much as possible. But unless you're doing this day in and day out, a lot of accountants have like a general practice, and cannabis is a small section of that. They're not going to use their company's resources to do their homework. It's a subject with a lot of opinions, and so very few of those opinions are going to favor your business and the outcome. Most of them are going to be conservative. You're going to see a lot of disputes that have landed against the taxpayers. But I'm hoping that this presentation will give you a little bit of a breath of fresh air. So if you're new to this subject, you're not going to be like overly worried. But it needs to be taken serious. You should not take it for granted. Some of the approaches that I'm going to introduce today would be considered aggressive because we truly are challenging 280E and we're challenging the IRS. And so I'm going to go ahead and jump in to my presentation by sharing some like a slide deck here. Okay, so a little bit about me. Noel did a good job, introducing me, so I won't spend a lot of time there. Now, and again, as far as 280E is concerned, you ought to know a little bit about this. You should be able to find it. This course is a 400 level college course. So you need to have a little bit of a background on what 280E is. And I'll tell you, essentially, it's a tax penalty imposed by Congress during the 80s to penalize drug traffickers so that they can't deduct their expenses. There was some pushback when it was implemented, and then the Congress conceded, I guess, that we would be allowed to at least take our cost of goods sold. So for farms, for example, 280 is not as impactful because most of the expenses that a farm accumulates are direct costs, like clones and soils and amenities and amendments and those types of things. You can also take equipment like dehumidifiers and greenhouses and those kinds of things. So a lot of the expenses and the labor, most of that goes into the production of costs. So therefore, they're not, farms are not as widely hit. And doesn't have as much 280 exposure. Same with processing. So if you're into extracts and those kinds of things, what would be considered non-deductible due to 280E are your sales, your admin costs, your maybe maybe your professional fees. Those types of things would be very much overhead costs, and therefore they would be disallowed by 280E. And so the area of the cannabis industry that gets hit by far the hardest is the dispensaries. Dispensaries can, on a surface level understanding of 280E, can take their purchases for resale, but that's it. They don't get their rent, they don't get their payroll, they don't get, anything. They really don't get anything. And so that's what, so when I started doing dispensaries back when I got my first dispensary clients back in 2015, I went to file their tax returns with a surface level understanding of 280E, and I was like immediately like, so this was 2015. They opened in 2014, and I quickly realized that they're going to be totally screwed if we file these tax returns. And I told them, do not file these tax returns. We need to figure out how to deal with this. This is outrageous. Like, how is this even possible? It's completely unreasonable. Like, that was my response, and that was definitely the response of my clients. So I went to Colorado for some community education where I thought, well, they're going to teach me how to deal with 280E, and couldn't have been any different. It was just this is 280E and your clients are screwed presentation. Fortunately, though, there had been some other savvy accountants and some tax attorneys there that had been doing their homework and researching how to mitigate 280E, and 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 so we landed on a code section called 263A. And 263A is a manufacturing, a code that forces manufacturers of certain size and profile to take their overhead costs and allocate them to inventory, and therefore postponing their deductions off to a new year into next year, so they can't immediately take their deductions. So for any legal business, that's a bad thing. The IRS is essentially saying, hey, you need to take your officer wages, your overhead costs, and you need to inventory it, put it into inventory, and then you can take the deduction next year when you have sales, and you could match those costs to the sales. That's essentially what cost of goods sold is, and cost of goods sold is allowed. So 263A seemed like it had potential to help, but we couldn't use that code section because in that code section, it clearly states that you don't use 263A if the expenses are disallowed by another code section, i.e. 280E. So when we discovered that little code section, we're like, oh, the 263A doesn't work. We can't use it. And so then we landed on another code section called 471, 471A at the time. Prior to the Tax Cuts and Jobs Act, it was called 471A. After the Tax Cuts and Jobs Act in 2018, they passed 471C, which superseded 471A. But 471A was our kind of go-to. And there is a reason why I'm telling you this. I'm not trying to bore you with this. The point of me telling you this story specifically is to show you when I get to the point, which it's kind of, I'm building up to the point, the IRS will say one thing and then do something different, okay? That is a very, very important point to understand for when I get to where we are now. You will know that the IRS, you will be reminded that the IRS says one thing, but then oftentimes will do another. And that's an important part. So 471A was a little bit of a reprieve, a very, very flimsy argument for dispensaries to be able to allocate square footage and payroll and be able, so we would do like square footage schematics. And we'll say like, okay, when the bud tender is in the back, bagging, tagging, weighing product, that's deductible payroll. And then when they're in the front selling to customers, that's not deductible. And then we would do square footage allocations based on schematics, like a drawing of their dispensary, and we say, okay, well, 30% of the dispensary is used for inventory management, so that's deductible, and then the rest of it isn't deductible. And that gave our clients just a little bit of a reprieve, just a little bit. And again, it was a flimsy argument because at that time, 471A was not, it was only for manufacturing companies. It wasn't for retail. Like, so if the IRS wanted to dispute it and say, hey, 280E applies across the board, they would. They could because this clearly is a retail company, not a manufacturing company. And 471 at that time applied to manufacturing companies, but they did condone it. When they did audit, they would look at the 471A methodology and be like, you know what, we accept your reasonable use of 471A. And that was good. So we used that. But then but then in 2018, the Tax Cuts and Jobs Act passed, 471C. And I'm so sorry, I have a different slide deck that has all of that illustrated, but this is not the point of this presentation. The point of this presentation is New Mexico top organics, where we're at today. But I'm telling you the whole history because now I'm on a roll, so I'm going to keep doing it. 471C passed in 2018. And essentially, it totally it killed at that time. We thought it killed 280E, and the reason why is because it incredibly simplified the 471 code. And what it did was it allowed it to apply to all businesses, all business types, manufacturing, retail, or whatnot. And it pretty much says that any business under 29 million, now it's $29 million in gross revenue. So that's most of the cannabis industry, can calculate their inventory based on any methodology that they want, as long as it matches their books and records. So I'm going to repeat that. 471C allows businesses to choose an inventory method that of their choosing, as long as it matches the books and records. And it's a very simple code section. It's very simple. It's very straight to the point. And it really just made it super simple, and our arguments and our reasonable basis for using it much more defensible. So at that time, us and some savvy other accountants started to move almost all of we abandoned that square footage allocation. We abandoned the payroll allocation, all that stuff. That was way too complicated, too flimsy of an argument. Nobody could really track that anyway. It was just like us throwing a bone. We're just saying, hey, could you not bury our clients in tax debt? Let's get IRS, can you give us something reasonable? And they did. They let us have that. But 471C made it absolutely legal for us to move our 100% of our payroll, 100% of our facility costs, and a lot of other essential expenses into inventory, and thus deducted as the cost of goods sold. And we use it to this day. And that was 7 years ago that we started using that. Granted, okay, and then here's the point. Here's the point. The IRS got wind that the cannabis industry was using that as a loophole, and they tried to close it down. And they did it through regulation. And they pretty much they copied and pasted that code set, that little clause out of 263A that I was telling you, that where the accountants read that and said, okay, no, we can't use 263A. They copied and pasted it and put it into regulation and tried to apply it against 471C. And it pretty much, through regulation, they pretty much said that the cannabis industry could not use 471 by putting in that clause saying that you cannot use 471 if the expense is otherwise disallowed due to another code section. Now, the important difference, the distinction there, and this is the whole point, is that the IRS doesn't actually write the tax code. Okay, the Congress writes the tax code, and the IRS does two things. They enforce the tax code, and then when there's ambiguity in the tax code, they can fill in the gap, and it's usually to the favor of the IRS. So when the accountants are like, hey, this tax code is confusing, what do we do, IRS? They will put in regulation, and they will say, okay, this is how you interpret this code. And it's usually in the favor of the IRS. That's how it goes. But in the case of 471C, that regulation was not based on any tax code. It was simply a method of deterrence. They put it on there like a wet blanket, and it deterred a lot of the accountants at that time from not using that code section, and they stopped. A lot of people stopped. But when we went to our tax attorney colleagues and we're like, hey, what is happening here? Do they have the right to do this? The tax attorney colleague said, no, they don't. They can say that, but there's no teeth. This is all bark and no bite. There's no teeth. If this was disputed in tax court, the IRS would lose because there is no support for this in the tax code. So that was the case of the IRS kind of you know, trying to enforce above the law. They were acting above the law. Here now, 2026, no tax, the IRS never took it to tax court. They never disputed it in tax court, meaning those accounts that continue to use 471C, even though the IRS said they couldn't through regulation, we kept using it and we used it aggressively. It was never taken to tax court. The IRS never fought it. They never fought it. That's the important thing here. The IRS said one thing through regulation and they didn't enforce it. It was all deterrence. Okay. So that was the important part of that whole conversation. And again, 471C is now kind of a conservative method for mitigating 280E, and you can be aggressive with it. That is legally allowable. Some accountants are like, no, we're not going to do that. We're going to use more of like a 471A methodology where we're going to make you jump all through all these hoops. We're going to do square footage schematics. We're going to like track your payroll. What is inventoriable activity and what is not? That is unnecessary. And it's no more defensible than just saying, you know what, I'm going to deduct 100%. I'm going to keep this simple for my business because doing it otherwise is too difficult, too costly. I'm going to keep the use of 471C simple. You can do that. That is legal. You need to make sure it's you're properly filing it. It is opposed to the IRS regulation, so you have to use a form called 8275R, and you need to let them know, hey, we see that you said that we can't use it, but we're going to use it anyway. Some accounts are not even doing that. You need to be aware of that accounts are using 471C are actually doing it in opposition of the actual regulation that the IRS put out. The IRS said you can't do it, and the people who are using 471C are saying, yes, we are going to do it, but we recognize that it doesn't qualify. Okay. Back to my main presentation here, and I hope that was informative in some way. But what is a Schedule 1 substance? What is that? And this is where this all gets interesting. Where are we now? And so first of all, I'm going to talk about what are the criteria for a Schedule 1 substance to be considered classified as a Schedule 1 substance. Well, a Schedule 1 substance has a high abuse potential, no accepted medical use, lack of safety under medical supervision. Okay, so that is, you know, I don't know if that doesn't seem like cannabis to me, but that's what Congress decided back when they created the Controlled Substances Act, and they implemented this criteria. They're like cannabis. Even I heard some audio, and I don't think it was AI generated, of Nixon saying that, hey, I don't think it was actually literal audio. It was kind of interesting. I don't think and then Nixon was like, I don't think cannabis is a Schedule 1 substance. But you know what? They hated cannabis. They hated the culture, bunch of alcoholics. And they decided, you know what? You know, cannabis is a dangerous substance and with no medical benefit and, you know, reefer madness, all that stuff. So they put it in Schedule 1, which is insane. Schedule 2, high abuse potential, some accepted medical use, severe psychological or physical dependence. That doesn't sound like cannabis to me, or else I would be like a total junkie. You know what I mean? So I just want to put that is the criteria. The important part is this is the criteria: high abuse potential, highly dangerous, no medical benefit. That's Schedule 1. Well, in 2023, when Biden was in office, he told the HHS to determine or to reevaluate whether or not cannabis, the classification of cannabis was actually accurate. Did it essentially meet the criteria of a Schedule 1 substance? And they wrote a letter, the HHS wrote a letter to the DEA saying that cannabis was solidly a Schedule 3 substance. I'm going to let you guys read this a little bit. Let me see here. Where's the meat of it? Marijuana meets the findings for control in Schedule 3. Based on my review of the evidence and FDA's recommendation, it is my recommendation as the Assistant Secretary for Health that marijuana should be placed in a Schedule 3 of the Controlled Substances Act. So why would they say that it should be put in a Schedule 3 if it actually met the criteria of a Schedule 1 or Schedule 2? And this letter came with 250-page document from the FDA saying that it does have medical benefits, it is not highly addictive, and it is not highly dangerous, and it's not highly dangerous. Here are some highlights here. 38 states accept medical marijuana, scientific evidence for pain, nausea, etc. Addiction risk, cannabis dependence, 9% of users versus heroin, which is 23, and tobacco, which is 32. So much lower potential for addiction. I don't know how much alcohol is in there. That would be interesting. Danger, no recorded fatal overdose, far lower health risk than heroin, cocaine, or meth. And heroin is a Schedule 1 substance, while cocaine and meth is a Schedule 2 substance with fentanyl. So I don't know. I mean, clearly cannabis ought not be considered a Schedule 1 or Schedule 2. We can all agree on that. So here's the government, though. The important part of this is that the government is saying this. Okay, this is the end. And this is a scientific body. The DEA is an enforcement body, and the Health and Human Services is a scientific body. Who ought to be the one to determine whether or not a substance has medical value, is highly dangerous, highly addictive? Should the DEA be the ones to determine that, or should the HHS be the one to determine that? Well, the HHS says that it should be a Schedule 3 substance. Okay. I'm going to move on. Okay. So this is where it gets interesting, and a lot of you have watched these presentations. This is not new to you, but for a lot of you who are relatively new to 280E, this may be new to you, and this is somewhat mind-blowing, and when it came to my attention, it was mind-blowing for me too. 280E, when you look at the tax code itself, doesn't state that 280E applies to businesses that are trafficking in substances that are classified as a Schedule 1 or Schedule 2 substance. What the language in 280E actually says, and this is important because this is Congress, the highest authority, it says that 280E applies to businesses trafficking in substances that fit the meaning of, or within the meaning of Schedule 1 and 2 of the Controlled Substances Act. So I'm going to repeat that again because I think the IRS reads this and has interpreted it differently than what we as tax accountants, or at least the ones that are brave enough to read it and then prepare tax returns based on what the tax code says. But you read that, if I'll let you read it again, but it says, it doesn't say classified as, it says within the meaning of a Schedule 1 and 2 of the Controlled Substances Act. That's the literal, this is a copy and paste from the language itself. So what that means, before I go on to the next slide, is that there's a debate here. Now, the IRS, you may have heard about agents talking about there was an accountant continuing education conference where and it was for cannabis, and this was in Denver, like maybe 4 years back, 3 years back, something like that. And they had an IRS agent speak about whether or not cannabis or 280E still applied, considering the HHS's letter. And he said, without a doubt, it does apply, and if you do anything otherwise, we're going to audit you. And then that presentation that IRS agent had made during this cannabis conference then got written by one news publication and then spread to all cannabis news publications, and everybody said, 280E applies, the IRS says 280E applies, etc. And yeah, according to them it does, but one agent going out there and saying 280E applies doesn't mean that it's sink or swim or whatever. I don't know. It's not the end all be all. Then the IRS wrote what is considered like a bulletin or a memo. I like to call it a strongly worded email, where they came back and they said, hey, 280 applies, and and until it's rescheduled. That's what they said. And then that was taken and blown all over the media. Now you got to remember that a bulletin is the lowest form of authority of the IRS, and a guy speaking at a presentation is also a low form of authority. And then you got to remember that they tried to close the loophole of 471C by putting out regulation, which is of the highest form of authority under the tax code. So I don't know what the IRS's clear opinion about their interpretation of this is that 280E applies. But if you read it, it really is ambiguous. And in fact, I'm interpreting as 280E does not apply ahead of rescheduling. Okay. And this gentleman, he agrees with me. New Mexico Top Organics, Nathaniel Pollock, representing this company out of New Mexico, who was in audit. They've been very successful in audit for years. They've been haggling with the IRS for years and have been successful. And they said, you know what? And we don't think 280 applies because cannabis is not within the meaning of a Schedule 1 or Schedule 2 substance. There was some pushback. Oh, and we're going to hear back. So this case is currently being litigated, or it's waiting to be heard, or I'm sorry, we're waiting for a response from the IRS. I've visited with Nathaniel a couple of times. Super sharp guy. I'm so glad that he's working on this case. So this slide is outdated. We were supposed to hear back from the IRS what the IRS's thoughts on within the meaning of it was back in January 16th, but they got an extension and they moved it into March because Nathaniel is thinking that they're bringing in the big guns for this. They're going to try to wiggle their way out of it and come up with a way to enforce it, like an argument to say, well, Congress intended cannabis to be a Schedule 1 substance, period. And 280, and they meant 280 apply, period. There's going to be something, they're going to come back with something and try to keep it enforced. But essentially, the main crux of this is that same argument. So we have been filing tax returns without reducing deductions for 280E for some time. This is our third year. And finally, it is now being taken to tax court, and we're going to be able to, finally get a conclusion on this, even though it may still take a few years. Okay. Now, one of the big arguments that the naysayers are saying, or the IRS is saying, is that, well, what did Congress mean by within the meaning of? And Nathaniel, in his court case, puts it so elegantly. What they meant was within the meaning of, does cannabis fit the criteria of a Schedule 1 or Schedule 2? That's what they meant. And the reason why they did it that way was not because they were concerned about substances applying when they shouldn't, like cannabis, but they wanted to actually throw out a larger umbrella and capture substances that don't fit or that do fit the criteria of a Schedule 1 substance, but isn't necessarily classified as one. So that's what's so beautiful about this. Let me say it again. Okay, so what did Congress mean by within the meaning of? Well, they meant the criteria of, is it highly addictive, highly dangerous, and has no medical benefits? If that's the case, 280E applies whether or not it is classified on the Controlled Substances Act as a Schedule I substance, because they wanted to throw out an umbrella and capture other substances that the DEA may have missed. They wanted 280E to apply to other substances that the DEA missed. Now, we as the cannabis industry could say, well, in that case, cannabis does not fit the criteria of a Schedule I substance according to the scientific body of the federal government itself. And therefore, 280E doesn't apply. And here's the other thing is in the Controlled Substances Act, there's other areas in the tax code that where or not the tax code, but the Controlled Substances Act and the tax code, where they say classified as, where there's language in the tax code and in the Controlled Substances Act where it talks about substances being classified as. Okay. I mean, these are just the important semantics of the language, the debate about the language. What was Congress's intent by using the language within the meaning of there's court precedents where they ruled in the favor of the plaintiff saying that, hey, Congress is required to use plain language when they're writing law. It can't be archaic. It can't say within the meaning of if it means classified as. So it's just all important stuff here. Meanwhile, we've got synthetic cannabinoids that have been FDA approved Schedule III substances for years since the 80s. So what is it that Congress is saying that, or the DEA is saying is so dangerous about it? Is it the flower? Is it smoking it? Why would synthetic THC be considered Schedule III and the flower be Schedule I? Okay, so there was a lot of debate about the medical aspect of it. The DEA was asked to reevaluate whether or not cannabis had medical benefit back in 2016. And the DOJ's Office of Legal Counsel actually went and reevaluated that test that the DEA was using. And they decided, they came back and said that the DEA was flawed, fundamentally flawed in terms of the test it was using to determine whether or not cannabis had medical benefit. Here it is, right here. So this is from the Department of Justice itself. The approach that the Drug Enforcement Administration currently uses to determine whether a drug has currently accepted medical use and treatment in the United States under the Controlled Substances Act is, quote unquote, impermissibly narrow. An alternative two-part inquiry proposed by the Department of Health and Human Services is sufficient to establish that a drug has a currently accepted medical use, even if the drug would not satisfy DEA's current approach. So that was based on, that determination was based on the DEA's use of that test back in 2016. So that means that cannabis was never going to be able to be considered anything other than a Schedule I substance because the DEA was using a flawed test. Okay, so the test was flawed. So all those people who have been being hammered by 280E all these years were being hammered because the DEA was using a flawed test to determine whether or not cannabis had medical benefits. So there is a very, very strong argument that you can say that 280E didn't apply back in 2016. And then this is the HHS's two-part test. Current experience with medical use of marijuana in the United States. let's see, current experience with medical use of marijuana in the United States by licensed healthcare providers. We have that. FDA evaluates whether there exists some credible scientific support for at least one medical condition. We have that. Cannabis does have medical benefits according to this two-part test. And so therefore it never did meet the criteria of a Schedule I substance. So I think by this time, you guys probably, I'm hoping you're convinced this is not quackery. I'm not an attorney. I didn't make this stuff up. This is all stuff that's coming from other people, other professionals that I have vetted. I have, I've looked at the documents. I can see this is true. There's a court case pending right now. And because of that, you guys don't have to proactively pay tax on phantom income. There is a form called an 8275 that is included in the tax code for the purpose of a taxpayer to dispute the interpretation of the code. If we feel like the IRS is not interpreting the tax code properly, we can proactively not pay tax on phantom income and dispute it by using what's called a Form A275. We're allowed to do that. That is legally available. You can look it up. The IRS did say that it wasn't going to protect you. You can't. So that, again, they wrote a strongly worded email saying that, hey, you can't use 8275 to say that cannabis or 280E doesn't apply. Again, that is not regulation. That is a strongly worded email, essentially. Are they going to audit everybody who is proactively not paying tax on phantom income, or is amending returns to recapture their refunds, to recapture those lost deductions? I don't know, but so far it hasn't happened, at least not for our clients. Okay, so, this is some interesting stuff here. The whole rigmarole about whether or not cannabis, the whole process with the DEA, it says in the Controlled Substances Act itself that that if the Secretary of the Attorney General or the Secretary of the Attorney General shall be binding on the Attorney General of the Department of Justice as to such scientific and medical matters, and if the Secretary recommends, and the Secretary of the Health and Human Services recommends that a drug or other substance not be controlled, the Attorney General shall not control the drug or the other substance. So as soon as that letter went to the DEA, all of these like court proceedings and all that jazz, that's all unnecessary. According to the law itself, it should have been rescheduled. And in fact, I read another article, and I neglected to get clips of it here, by another attorney's office, which I thought was pretty compelling. They said that the Attorney General has every authority to reschedule a substance based on the recommendation of the HHS without having to go through all these court proceedings and stuff. It's all a circus. It's all a show. Even Trump signing the executive order to, as soon as possible, reschedule. As soon as possible meant immediately. They could do it immediately, but they're not doing it. They're acting above the law. There's a little bit more here on, so back in, I can't remember, 2024, I guess, the Supreme Court overturned, oh no, Loper Bright versus, yeah, okay, I'm getting them mixed up. But you remember that the Supreme Court overruled Roe versus Wade, right? That means that the federal government is taking more of a federal, or the Supreme Court is now taking more of a federalist view on things, a states' rights view. And there's lots of unfortunately, they have been failing when they've been taken to the Supreme Court, but there's a few good arguments where they're not even attempting to, the Supreme Court isn't even like hearing some of the how 280E is, and the Controlled Substances Act is unconstitutional. Chevron deference was overturned, which essentially gutted the FDA, or not the FDA, but the federal government from enforcing its own regulation and actually dropping the authority of federal regulation down. So even when the IRS says, hey, 280E applies, it doesn't apply until it goes to tax court. And right now we have a court case pending, and therefore, as long as you have a more reasonable than not basis for this court case that definitely has merit based on what I just told you today, you do not have to proactively pay tax on phantom income. You can deduct, you can take your deductions, and you put in the 8275R. It needs to be well written. It needs to present your arguments well, but you can put that in there, and you do not have to pay tax on phantom income. They may audit you. Yes, they may audit you. So far, there hasn't been a lot of that. There are audits. I'm not saying they're not happening, but the IRS is at an all-time low in terms of staff and funding, and it's taking, like for amended returns, for example, it used to be 6 weeks to 3 months for you to get an amended return processed. It's on average now 13 weeks, and that's from them themselves. That's from the IRS. The IRS told us that it's taking on average 13 months for an amended return to get processed. During the Biden administration funded the IRS at $80 billion. Then the Trump administration backed that out. When they received the money, a lot. I don't want to overestimate it, but I think it was like, I heard that 40% of the IRS retired, and then they rehired a bunch of people that were new, and then once Trump got into office in 2025, the IRS shrunk by 30%. They do not have time to mess with this. If you have a well-prepared tax return that's clear that you're willing to take this to tax court, I don't, it's just my theory that they might not do it. But you have to take it into consideration. You cannot, this is not advice. You're the one bearing the risk. All right. I think that I'm gonna stop there with my slide deck. And I'll tell you a little bit about what Noel, I know we don't have a lot of time, and I apologize. I kind of went off on a tangent a little bit. But
No,
I
it's
wanted to
fine.
talk about like my offices, or what's happening with people who are attempting to get refunds when they're amending. So moving forward, you have a more than reasonable argument to not reduce your deductions due to 280E with the court case that is outstanding. The New Mexico Top Organics case is outstanding. So until that gets litigated, the IRS may audit you and dispute that with you. You could take it to appeals. You can take it to tax court. But ultimately, you could move forward for 2025 and before. If you haven't filed your tax returns, you could potentially take a no 280 approach now. And then you can even potentially amend solidly to 2023, because when the HHS said that cannabis doesn't meet the criteria, 280E stopped applying. Going back further than 2023, you might argue that the DOJ said that the Department of Justice, the Office of Legal Counsel said that the DEA's test for determining whether cannabis had medical benefits was flawed, and it clearly does have it. So it never really was considered the criteria. It never met the criteria of a Schedule I substance. So now there's been pushback on amendments. I thought at first, well, they're going to get the refund or they're going to get audited. But what has been happening is we've been getting denials. So we've gotten a handful of denials. It's a pretty good percentage. Most of them are coming back with refunds. They're coming back with reduction in liability, but some of them are getting denials. And what does that mean? Well, the next step is you got to go to the appeals. And then there has been some, whether we've been waiting for the appeals office to get back to our clients and so that we could have like a conversation with them. The outcome of going to appeals is they could say, no, absolutely not. You're not going to get your refund. Or they could say, hazard of litigation. We'll split it with you. We'll split your refund with you. I don't know what's going to happen. We haven't been there yet. But amending, you can do it. It's legal. You can amend your tax return. You use 8275R, amend your tax return. You can go for the refund. If you get a denial letter, you could take it to appeals. That's where we're at. Okay. We got probably a lot of questions.
We do have a lot of questions, Justin. I looked over, a lot of them are along the same kind of thread. So I'm going to try to consolidate a few together. Mainly, people are asking more specifically. You mentioned that some clients have had pushback from the IRS. So basically, they're asking, are you using a tax attorney or filing your own the 8275 forms?
Yeah.
And this,
Mhm.
can you give an estimate of the
I,
success rate for those?
Oh, going forward, which we've been doing for a few years, we use an 8275 with specific language. First for using 471C, and another one to say, and we don't believe that cannabis fits the meaning of 280E, therefore it doesn't apply. That has been blue skies, like nothing, no pushback on that. 100% success rate. Hundreds and hundreds of tax returns have gone out. Thousands, over 1,000 tax returns have gone out with using that approach, and that has been good. If you're a very large company, like I don't know, you're looking for a million, like you're going to get out of paying $1 million in taxes, you might want to consult with an attorney. There are attorney groups doing what's called an opinion. Um, some people believe that holds more weight. If you go for like a refund that's of a certain size, I think it's $2 million, you really probably need to have an opinion written. But for most of the small businesses, an 8275 works. That's how you tell the IRS that you disagree with them, and it prevents you from penalties. Now, there are some people saying that it doesn't, and that's totally BS. That's what the 8275R is. That's the primary purpose of it, is for you to say, hey, we don't agree with you. And if you decide to audit me and you win, then I don't get penalized. I'm back where I started. But so far that hasn't started. We have been amending. The statute of limitations right now it's not right now, it's 3 years. So you could potentially amend a 2022 tax return going forward. If you haven't filed your return, then you may still be able to use more aggressive approaches for those years as well. We have been getting, so there's about a 20% chance right now of all of the refunds and all the amendment returns where we were going for refunds. It's usually only if we're looking to get a check. If it's to reduce the tax liability, that's been pretty successful. It has been successful. If you're looking to get a check, we've gotten denials, and that rate is about 1 in 5 right now. So not insubstantial. It's not an insubstantial amount. So you have to decide, well, do I want to go for the refund and pay an accountant to do this when there's only a 1 in 5 chance that, or there is a 1 in 5 chance that it could get denied, and then I'd have to go through some other rigmarole. We could take a case through the appeals process, but we're not attorneys. So if you go to tax court, you would need an attorney. And of course, we would definitely want to talk to you about that if you were interested in doing that, because we do have connections with Nathaniel Pollock and are actively like figuring out what are the next steps for these denials. Like, let's see if we can get more court cases in the docket, in other districts and whatnot. So, okay, what's next?
So related to that, so if people are asking, so if they're going to try to say that 280E does not apply,
Uh,
there's no penalty to them if the IRS disagrees. They're
no,
not
you need to. It
the
needs to
audit.
be well written. You need to cite the New Mexico Top Organics case and and he writes the language in there. He's got it in that court case. You can take that and you can put it in to an 8275. I actually had an attorney write it up. Nick Richards, actually Nick Richards' office. He wrote it. They do opinions though, um, so I mean the cost. I don't know what the cost would be to do that. He might charge for some language just for the 8275R to give to your accountant, or he'd want you to do an opinion, because the attorney firms, they write opinions. They tend to be a little bit more expensive than just hiring an accountant that has a really nice 8275R. He's out of Colorado. He's been like on the forefront of being aggressive on the aggressive approaches that the accountants have been taking. So he's a whole wealth of knowledge. But
Okay.
that is so no, yes, the 8275R, the number one point of it is to protect you from penalties. For it's not a frivolous law, it's not frivolous. What we're doing is not frivolous. It has merit. And that's the important part to know that you're not doing anything fraudulent. What the IRS is doing is fraudulent. 280E is fraudulent. Like it clearly is fraudulent. But hey, it's the government. So what are you going to do? Yeah.
You mentioned the New Mexico top organics case could take some time to pan out. I mean, even
Yes.
potentially could drag on for a year or 2 years.
Mhm.
You never know, I guess. So if should that case result in favor, not in favor of New
Not in
Mexico
favor.
top organics, does anything happen retroactively to people who have filed under this
It, it could.
proposition?
I mean, it really, it very much could. You might then be on the hook for it. But um, it would blow my mind if that was the end of, if that was the end. That would be like, to me, like I just showed you the arguments,
Yeah.
uh, and the federal government doesn't surprise me in terms of like its shenanigans. So, but my faith in the judicial system is somewhat shaken anyway. But what would happen is the IRS is going to push back, then it's going to go to a judge, and then the judge has to decide if Nathaniel's arguments, have merit. Okay, if they have merit, then we're good there. We can keep moving forward. If we lose, maybe it has merit, but he says, well, the Congress meant that cannabis is Schedule One substance. It doesn't matter what the criteria is. They wanted 280 to apply to cannabis, period. Then, you know, then I guess we're screwed. I really don't know what would happen, but I just know right now you don't need to be proactively paying tax on phantom income. Now, as an accountant, I would say, okay, well, we did lose that, so now you have to re-amend your returns, and you need to pay all that tax. I think I might that's when that day is the day I retire. I have to tell you that.
Okay. Well, recording this, so I'll send it to you if that happens. I wouldn't expect either,
I
but
will
I
retire
never
before I
know.
say that you have to amend your return to pay phantom income. But yeah.
So another, I think, a really important question, is there a difference for medical only cannabis businesses as opposed to adult use? Because we're talking about medical definitions under the schedules.
Yeah, I mean, I think I felt like that's where like the executive branch and the DEA are going to try to go with rescheduling. If they're going to continue to try to cockblock the rescheduling, that's where they're going to go. They're going to say something like, "Oh, we have FDA approved cannabis." Like, of course, the FDA is not going to approve the smoking of marijuana flower. So, so I don't know. I think cannabis definitely, there are more arguments about, I live in Oregon, so I'm very, very focused on the rec markets. So I don't know that answer, but certainly the federal government, they made several actions saying that, hey, we're not going to enforce the Controlled Substances Act on medical marijuana. So medical, you definitely have more of an argument there. But again, does marijuana, even at its worst form, meet the criteria of a Schedule 1 or Schedule 2 substance? It doesn't.
Okay,
So
so that's what this theory would apply to both
because it only
businesses from
has
your
to,
perspective.
here's the thing is it only has to not be one of those three things. It either has it if it has medical value, it's not a Schedule 1 substance. If it's not highly addictive, it's not a Schedule 1 substance. If it's not highly dangerous, it's not a Schedule 1 substance. It
It
only
only
needs to
needs to
be
be
one of those
one of
three
those three
things.
things.
So
So
it doesn't
it
matter
doesn't
if
matter.
it's medical or not. Like if it's none of those three things, it's not a Schedule 1 substance and 280E doesn't apply. So in Nathaniel's court case, there's two more arguments that he presents. And one of them is the fact that the federal government doesn't enforce the Controlled Substances Act on medical cannabis. So therefore, 280E should not apply because 280E is a result of the Controlled Substances Act.
Okay.
So you do have more of an argument, and there is probably going to be more defense there, but I'm like advocating for all cannabis businesses.
Someone asked if you think there's a potential for a class action suit, I would assume here, with,
Yeah,
your
there is. I
the
don't think
IRS.
class action's the right terminology. I have talked to multiple attorneys. I talk to attorneys all the time, and they did. Nathaniel Pollock himself was saying that you have to go into it. You have to be audited, and some of the big companies like Trulieve, these guys, they might be having something going on under the scenes. If anybody knows what's happening with those companies, let me know. Like if you've got inside information, but my understanding right now is that you have to be audited first. So New Mexico Top Organics was audited, and you have to be willing to take that case to tax court. Okay. That's how you get into tax court. Otherwise, when we do the amendments, there's and they get denied, then you have two options. They're not exclusive of one another. You can first go to appeals, see if you can get some sort of hazards of litigation settlement, meaning I'm going to talk to this independent appeals officer, and that person's going to say, like, your argument has merit. Hey, let's not go to tax court. Let's split it in the middle. We'll give you half of your refund and to avoid you to go to tax court. Or you just say, screw you, I'm going to tax court. And you go. Now, tax court would be if you have a liability and you're trying to get out of tax debt. Strangely, when you're looking for a refund and you're trying to get your refund, it doesn't go to tax court. You have to take it to what's called district court, federal district court. You essentially have to sue the IRS sue the IRS for your refund in federal court and go to federal district court. And Nathaniel's like, hey, we need that in multiple districts in order to really put pressure on them to let go of this and allow us to have our money. So it's kind of a complicated thing, and I'm not that far along in my own experience to know exactly what type of outcomes there are. We've got denial letters for amendments that have, the IRS wrote poorly written letters back to my clients saying that, we're not going to accept your amended return. And we have written letters to tell them, okay, we're going to take it to appeals. And that's as far as we've gotten. It takes on average 13 months for the IRS to process an amended return. They're way underwater in terms of staff. They're floundering essentially, but at the same time, that's bad and good for us. It's bad in that they're not processing our refunds very quickly. It's good in that there's no way that they're going to be able to deal with all this, so.
Okay. Unfortunately, I think we're out of time. I think that tackled a lot of the essence of a lot of the questions that we got. So hopefully, a lot of people feel that their questions were answered. And again, Justin has graciously offered to respond to any questions after the webinar. So we do have your information here, and he'll be able to do that. Did you want to add something, Justin?
Yeah, protective claim for refund. That is another thing you can do conservatively. Now that will not you will not get your refund until the New Mexico Top Organics passes. If it doesn't pass, you're not going to get, or if they rule where something happens and it stalls, um, the protective claim for refund will only work if something happens in the court system that rules in the favor. Um, I'm not advising it, but you can consider going for amending your return. Again, the impact is only that you're back at the beginning if they say no and you don't want to take it to the appeals or anything like that. Anyway, I'm going to do another webinar. I think my business partner and I will do another webinar. We'll send an email to the people who registered for this, and we'll have a Q&A. We'll do another Q&A. And
Okay.
again, it's a big conversation. I'm sorry that I rushed through it, but I'm happy to expound on any of the points that we've discussed.
Yeah, that's great. No, no worries. I mean, I think you did a wonderful job of packing in a lot of historical information as well as what we're looking at currently and trying to help people understand this very complex um, issue that we're dealing with. I dropped accounting freshman year of college as my major, so it was very helpful for me to hear about all this as well, a little more in depth than I've heard. So anyway, thank you so much, Justin. Thank you everyone who joined us today. Thanks to Calyx CPA for supporting this webinar and bringing it to everyone. And that's it.
All right. Thank you.
All right. Thanks, everyone. Have a good rest of your day.